$2,341,000. That's what was sitting in our company operating account on a Tuesday afternoon in March. I know the number because I'd checked it myself at 4:47 p.m. before I locked my laptop and drove home. I remember because I was doing payroll projections for the following month, and I remember thinking, we're finally in a good place. By Wednesday morning, that account had $11.12 in it. Not stolen in a hack, not drained by some outside criminal I'd never met, drained by the man whose name was on the lease next to mine, the man who'd stood next to me at our first office opening, who'd held my daughter at his own daughter's christening, who I had trusted with the financial keys to a company we built together over 6 years. My business partner didn't take that money in one moment of desperation. I would learn because a forensic accountant named Rebecca Chen would spend 4 months proving it, line by line, wire by wire, that he had been bleeding our company dry for almost 3 years. The overnight drain wasn't the crime, it was just the moment he finally stopped hiding it. He thought a shell company in Delaware and an account in the Cayman Islands would make him untouchable. He was wrong. This is the story of how I found out, how I built a case with a forensic accountant, an attorney, and eventually the FBI, and how 18 months later, every single dollar came back, and he traded his beach house for a federal prison uniform. Before I get into it, I want to say this story is about more than one bad partnership. It's about how easy it is to trust the wrong person with your money, and how the tools that catch financial predators, forensic accounting, subpoenaed bank records, the FBI's Financial Crimes Unit, actually work in the real world, not just on TV. If you've ever had someone you trusted take something from you, money, time, your sense of safety, I think you're going to feel this one in your chest. If stories like this hit home for you, hit subscribe because we cover fraud, embezzlement, and financial predators every week, and I promise you, some of these stories get even wilder than mine. Stick around to the end because I'm going to walk through the exact warning signs I missed so you don't have to learn them the hard way like I did. Let's get into it. In 2017, I was 34 years old, working as an operations manager at a mid-sized freight brokerage in Charlotte, North Carolina. I was good at my job. I understood logistics, the way freight moves, the margins carriers work with, the software that ties shippers to trucks to warehouses. But I was capped. I was making $71,000 a year, with a bonus structure that topped out around $84,000, and I had watched 3 different people get promoted over me into roles I knew I could do better. I had $38,000 in savings, I had a wife, Elena, and a 6-year-old daughter, Maya. I had an idea I'd been sitting on for 2 years, a boutique logistics consulting firm that would help small and mid-sized manufacturers, the ones too small for the big consulting shops to bother with, optimize their freight spend and supply chain. I'd done the math, I knew the market, I just didn't have the capital, and honestly, I didn't have the confidence to do it alone. That's where Daniel Cole came in. I met Daniel at an industry conference in Atlanta, a logistics and supply chain summit at the Georgia World Congress Center. He was working as a financial consultant, self-employed, and he had, by his own account, helped 3 small companies restructure their debt and add $1 million to their bottom line through better financial management. He had a laptop bag with a monogram, he had a firm handshake, and he remembered my name after hearing it once, which, looking back, should have been the first thing I noticed, not the last. Daniel didn't pitch me that first night. That's important. He asked questions. He asked what I thought was broken about the freight brokerage industry, and he actually listened to the answer, nodding, writing things down in a leather notebook like what I was saying mattered. We stayed in touch for 4 months before he ever brought up going into business together. He'd send me articles relevant to things I'd mentioned. He invited Elena and me to dinner with his wife Priya and their daughter, who was close to Maya's age. Our families became friendly. He came to my dad's retirement party. I went to his father-in-law's funeral.
By the time he said the words, "We should build this company together," it didn't feel like a business proposal from a stranger. It felt like a natural next step with a friend. Here's the part I want you to really pay attention to, because if you're ever starting a business with a partner, this is the exact mechanism that got exploited. Daniel proposed a 50-50 ownership split, which sounded fair, even generous, since he was putting in the initial capital, $140,000 to my $38,000, to cover the first year of overhead, office space, and a part-time bookkeeper. Because, as he put it, you're the operator, I'm the finance guy, let's both stick to our lane.
At the time, this felt like a division of labor. Looking back, it was a transfer of control. We formed Whitfield & Cole Logistics Solutions, LLC in January of 2018. I ran client relationships, freight optimization, and operations. Daniel ran the money. He set up our business bank accounts at a regional bank, he chose our bookkeeping software, and, this is the detail that would matter most 18 months later, he was the only signatory who could authorize wire transfers over $10,000 without a second approval. I agreed to that structure because he said the bank required a primary financial contact for larger transactions, and since he was already handling the books, it made sense for it to be him. I didn't push back. I trusted him. I had no reason not to. Looking back now, with everything I know, there were signals. I want to walk through them honestly because I think a lot of people watching this will recognize the same pattern in their own lives, whether it's a business partner, a spouse, or a friend who manages shared finances. Red flag 1. Daniel was resistant to using accounting software that gave me direct login access. He said QuickBooks Online was clunky for what we need and that he preferred a desktop version he managed, sending me PDF summaries monthly. I asked twice over 2 years for direct access. Both times he said he'd set it up next week. It never happened. Red flag 2. In year 2, Daniel started taking more frequent trips, Vegas conferences, a client retreat in Cabo that I never actually met the client from. He always had a plausible story. He always came back with new client leads, or at least the appearance of them. Red flag 3. Our revenue was genuinely growing. We ended year 2 at $1.8 million in gross revenue, a real, legitimate number, because our actual client work was good, but our cash position never seemed to reflect it. When I asked about this, Daniel explained it as growth eating cash, which is a real and common phenomenon in growing service businesses, and it satisfied me because it was, on its face, a legitimate explanation. Red flag 4. He started referring to certain vendors I didn't recognize, a logistics data analytics subscription, a specialized freight audit consultancy that appeared as line items on the PDF summaries. When I asked what they were, he had smooth answers, tools we needed, standard cost of doing business. I never once asked to see an invoice. I want to be honest with you. None of these on their own screamed fraud. That's exactly why they worked. Fraud rarely looks like a masked man breaking into a vault. It looks like a series of small, reasonable-sounding explanations from someone you have no reason to doubt. In our third year, 2020, I made a decision that I now understand handed Daniel the final piece of leverage he needed. Our bookkeeper, a part-time contractor named Linda, retired. Instead of hiring a replacement, Daniel suggested he'd absorb her responsibilities himself, saving us roughly $28,000 a year in contractor fees. He'd just gotten his CPA license reinstated. He'd let it lapse years earlier, he explained, but had recently completed the continuing education requirements to bring it current. It seemed like a competence upgrade, not a warning sign.
From that point forward, Daniel was the sole person with visibility into our banking, our books, our tax filings, and our payroll. No second set of eyes, no outside bookkeeper cross-checking his entries, no controller, just him. I signed off on this arrangement because it saved money and because 6 years into our friendship, I trusted him completely. That trust is what he spent the next 2.5 years quietly converting into cash. It was a Wednesday in March, and I was trying to process payroll for our 11 employees. I logged in to what I thought was a shared payroll portal. Actually, I'd need Daniel's approval to run it, which was itself part of the control structure, and I got an error: insufficient funds. I remember staring at the screen for a full 10 seconds, assuming it was a glitch. I'd verified this myself the day before, $2,341,000 in change sitting in our operating account. I called our bank's business line directly, gave them my identification, and asked them to read me the current balance on the Whitfield and Cole operating account. $11.12. I asked her to repeat it. She did. I asked if there had been a fraud alert, a hack, anything flagged. She said no. The withdrawals had been authorized in a series of wire transfers over the previous 18 hours, all from the account's primary signatory. That was Daniel. I called him 4 times in the next 20 minutes. No answer. I texted him. No response. I drove to the office. His car wasn't there. His desk drawer, which usually had a spare laptop charger and a stack of business cards, was empty. I called Elena and told her what was happening, and I remember my voice not sounding like my own voice. I called Priya next, thinking maybe there'd been a family emergency. She hadn't heard from him since the previous night either, and she sounded as confused and frightened as I felt. Over the following 72 hours, with the help of our bank's fraud department, I got a clearer picture, though it would take Rebecca Chen, the forensic accountant, months to get the full picture. Here's what I knew in that first week. $2,330,000 had left our operating account in 11 separate wire transfers over an 18-hour window, all initiated from Daniel's banking credentials. 2 LLCs I had never heard of, Meridian Freight Analytics LLC and Coastal Logistics Advisory Group LLC, both registered in Delaware, both formed within the prior 14 months. Payroll for 11 employees, due in 4 days, could not be met. Our line of credit, which I hadn't known Daniel had opened against the business 8 months earlier, was maxed at $180,000, with the funds similarly untraceable at the time. Beyond the dollar figure, the damage rippled outward immediately. I had to make a call to my staff, people who trusted me, some of whom had left stable jobs to join us, and tell them I didn't know if I could make payroll. I had to call our 3 largest clients and explain, without yet understanding it myself, that there had been an internal financial issue and that their ongoing projects might be delayed. I had to look my wife in the eye and tell her that the retirement savings I'd rolled into the business 2 years earlier as additional capital, $60,000, was gone, along with everything else. Elena didn't yell at me. She just asked quietly, "How did you not see this?" And I didn't have an answer for her that night. It would take Rebecca Chen 4 months to give me one. My first instinct wasn't lawyers or the FBI. My first instinct was to reach Daniel directly, because some part of me, even staring at $11.12, wanted there to be an explanation, a trading account gone wrong, a payment to a vendor that had been misexecuted, anything other than what it actually was. On day 4, Daniel texted me back. Not a call, a text. It said roughly, "I'm sorry, I made some very bad investment decisions with company funds, trying to grow us faster. I'm trying to fix it. Please don't go to the police. I can make this right." I want to pause on this because it's a pattern worth naming. The vague, emotionally loaded apology that offers no specifics, no numbers, no accountability, designed to buy time and discourage you from escalating. It worked on me for about 6 days. I responded asking for details, a plan, anything. He gave me partial explanations, a crypto trading strategy that moved against us, a vendor payment platform that failed to process correctly, that shifted every time I asked a follow-up question.
By day 10, with payroll now genuinely at risk and employees starting to ask pointed questions, I contacted a business attorney, James Alvarez, who I'd found through a referral from another small business owner in my network. James's first question to me was blunt. Has he offered you any documentation, any bank statements, any specifics? He hadn't, not once.
James told me something that reframed the entire situation for me. He said, "The apology and the plea not to involve authorities is often the last move before someone disappears for good, or the first move in a much longer con to buy time to hide assets further. Either way, you need to stop negotiating and start documenting." This is where the story shifts from confusion to investigation, and it's worth explaining, in plain terms, what Daniel had actually built over nearly 3 years, because the sophistication of it is part of what makes this story worth telling. Rebecca Chen, the forensic accountant James connected me with in week 2, would later reconstruct the full scheme. But even in those first weeks, working with our bank's records and a preliminary review Rebecca did on a rush basis, 3 mechanisms became clear. First, shell vendor invoicing. Daniel had created at least 2 LLCs, Meridian Freight Analytics and Coastal Logistics Advisory Group, that existed only on paper. He generated invoices from these fake entities for consulting services and data analytics subscriptions and paid them out of our operating account, routing the money into bank accounts he controlled. Over the 2 years these entities were active, this accounted for roughly $640,000 in disguised theft, money that looked on the books like legitimate operating expenses. Second, payroll manipulation. Because Daniel administered payroll directly, he had added what appeared to be a contractor, R. Sandoval, Freight Compliance Consulting, who was, according to every record we could later find, a person who did not exist. Payments to this fictitious contractor totaled $215,000 over 16 months. Third, and largest, the final drain. The 11 wire transfers in that final 18-hour window, $2,330,000, represented every remaining liquid dollar in the company, sent to a mix of the Shell LLC accounts and, we'd later learn, directly to a cryptocurrency exchange account. Total confirmed theft, once Rebecca finished her full forensic reconstruction, $3,185,000 over 31 months. I remember when Rebecca first said that number out loud to me in her office, sliding a printed summary across the table. I'd been bracing for the final wire transfer total. I wasn't braced for 3 years of a slow bleed I never saw. And that's when I found the smoking gun. Rebecca told me later about a different piece of the puzzle, but I'm getting ahead of myself. Let's go back to how the investigation actually happened. James Alvarez gave me the same advice every good attorney gives a fraud victim in the early days. Preserve everything, document everything, and stop trying to solve this alone. On his recommendation, I hired Rebecca Chen, a certified fraud examiner and CPA who specialized in small business embezzlement cases. Her retainer was $15,000, which felt like an impossible amount of money to spend when I had $11 in the bank. But James was right that without her, I had no case at all, just a bad feeling and a missing partner. Rebecca's first move wasn't dramatic, it was administrative. She sent subpoena-ready requests through James for 18 months of full banking records, not the PDF summaries Daniel had been sending me, but the actual underlying transaction data, wire confirmations, and account opening documents from our bank.
James also advised, and this is a detail I think people underestimate, that a civil case and a criminal referral are not either-or. We filed a detailed complaint with the FBI's Charlotte field office, specifically flagging it for their financial crimes unit since the interstate wire transfers. People think forensic accounting is glamorous, Rebecca told me in our first working session. It's mostly spreadsheets. But the spreadsheets don't lie, even when people do. Over the following 3 weeks, Rebecca built what she called a transaction map, a chronological, categorized ledger of every dollar that had moved out of Whitfield & Co.'s accounts since Daniel took over sole financial control in 2020. She cross-referenced it against our actual signed client contracts, our real vendor agreements, and public business registration databases in Delaware and North Carolina. That's how she found Meridian Freight Analytics, LLC, and Coastal Logistics Advisory Group, LLC, both registered using a registered agent service, both listing Daniel's brother-in-law as the nominal organizer, though the banking access on both accounts traced back to devices and IP addresses associated with Daniel directly. She also found something I hadn't known to look for, a pattern of escalating crypto purchases beginning in late 2021, funneled through the fictitious R. Sandoval payroll payments, then converted through a major exchange into Bitcoin and Ethereum. The trading history, once subpoenaed, showed a pattern that looked less like investment and more like compulsive loss chasing. Large purchases, steep losses, larger purchases to recover the losses, a cycle that repeated at least 9 times over 14 months. This isn't someone who made one bad decision. This is a pattern consistent with a gambling-style addiction to high-risk trading. It explains the acceleration. People in this pattern don't stop stealing when they've taken enough. They steal until there's nothing left to take, because the goal isn't a number, it's chasing the loss before it. That reframed everything for me. This wasn't a single moment of greed. It was a slow-motion collapse that had been happening in the account he alone controlled for years, while he sat across from me at client dinners talking about our 5-year growth plan. By week 6, James filed a civil complaint on Whitfield & Co.'s behalf, seeking a temporary restraining order and asset freeze against Daniel and the Shell LLCs, a critical step because a civil TRO can freeze assets faster than a criminal case typically moves, buying time before funds can be further hidden or spent. The court granted a temporary freeze on the known LLC accounts, though by that point, the crypto conversions meant a significant portion of the money was already outside easy reach of a bank-level freeze. Covering state lines electronically, and the amount involved put it squarely in federal jurisdiction rather than a local police matter.
We were assigned a case number, and after an initial intake, a financial crimes investigator, Special Agent Maria Torres. I remember being surprised at how procedural that first meeting was. No dramatic music, just Agent Torres asking Rebecca detailed, precise questions about the transaction map, requesting the full forensic report, and explaining that federal wire fraud and embezzlement cases often take 12 to 18 months to build to an indictable standard because prosecutors want an airtight paper trail, not just a compelling story. We build these cases on documents, not testimony, Agent Torres told me. Testimony can be doubted. A bank record with his login credentials on it at the exact minute funds moved is very hard to argue with. I won't pretend this was a clean, linear process. There were real moments where it felt like Daniel might simply disappear with what remained. Near miss 1. About 5 weeks after the drain, Rebecca's tracing showed a fresh attempt to move roughly $340,000 remaining in one of the Shell LLC accounts to an account at a bank in a jurisdiction with weaker asset recovery cooperation. Because the civil TRO had already frozen that account 3 days earlier, the transfer bounced, but it was close. James later told me if we'd waited even a week longer to file, that money likely would have been unrecoverable. Near miss 2. Daniel briefly resurfaced 7 weeks in through a new attorney who reached out to James proposing a quiet settlement. Daniel would return $400,000 immediately, no admission of wrongdoing, in exchange for us dropping both the civil case and declining to cooperate further with the FBI.
It was a fraction of what was actually missing, and accepting it would have meant walking away from any criminal accountability. James's advice was direct. That offer tells you he's scared of what Rebecca is finding, and scared of prosecution specifically. That's a signal to push harder, not soften. We declined. Near miss 3. Around month 4, Agent Torres told us that Daniel had attempted to open new accounts under a slightly modified LLC structure, using an associate as the listed owner, a common technique to keep spending remaining funds while appearing, on paper, to have no assets. Because we'd already flagged Daniel and his known associate network with the FBI, this new activity was caught within days, and the associate, once interviewed, cooperated rather than risk being charged as a co-conspirator. Each of these moments reinforced something Rebecca told me early on that I now believe completely. In financial fraud cases, speed and documentation are the only real weapons a victim has. Every day of hesitation is a day assets can move further out of reach.
Here's the moment that actually broke the case wide open for the criminal side of things. About 4 months in, Rebecca was reviewing device metadata that had come back through a subpoena to the bank, records showing which IP addresses and devices had accessed the accounts tied to the shell LLCs. Nearly every login traced to either Daniel's known devices or a hotel Wi-Fi network in a city where, it turned out, records showed he'd checked into a hotel under his own name the same week, a detail that seemed almost careless. But Rebecca explained that in her experience, people committing this kind of slow-burn theft rarely think anyone will ever look this closely, because for years no one had. "And that's when I found the smoking gun," Rebecca said, tapping a printed login log. A wire transfer of $412,000, one of the 11 from that final 18-hour window, had been authorized from a device that, per hotel Wi-Fi registration records, was logged in under Daniel Cole's own name at 2:14 a.m., 6 hours before he stopped answering my calls. It placed him personally at the keyboard at the exact moment of the largest single transfer. Combined with the Shell LLC paper trail, the fictitious payroll contractor, and the crypto conversion pattern, Agent Torres told us this was enough for the U.S. Attorney's Office to move toward an indictment. 14 months after that Wednesday morning, with $11.12 in our account, a federal grand jury indicted Daniel Cole on charges including wire fraud under federal statute and embezzlement in connection with a financial institution tied to the interstate wire transfers. He was located, not hiding as dramatically as I'd imagined, but living under his own name in a rented condo 2 states away, having burned through a significant portion of what remained on living expenses and further trading losses, and was arrested by federal agents. He ultimately entered into a plea agreement rather than proceed to trial, pleading guilty to wire fraud, which came with a federal sentencing guideline range that, combined with the amount involved and his position of financial trust, resulted in a sentence of 7 years in federal prison, along with an order of restitution. Separately, our civil case, which had continued in parallel, resulted in a civil judgment against Daniel personally and against the Shell LLCs for the full amount Rebecca had documented, $3,185,000 plus legal fees and costs, bringing the total judgment to just over $3.4 million. I want to be honest about this part, because I think a lot of these stories skip the messy reality of asset recovery, and it matters for anyone watching this who's in the middle of their own case. We did not get 100% of the money back. Here's the real breakdown once the frozen accounts were unwound and the restitution order began processing. $1,890,000 was recovered directly from the frozen Shell LLC accounts and the remaining line of credit funds, thanks to the early civil TRO. $310,000 was recovered from liquidating assets Daniel still owned outright, a boat, a second vehicle, and equity in the rented condo's underlying investment account, seized as part of the restitution order. $240,000 was recovered over the following 2 years through the federal restitution payment schedule, garnished from Daniel's prison work assignment wages and later expected wages post-release, though this portion continues to be paid incrementally. The remaining balance, roughly $745,000, primarily tied to the cryptocurrency trading losses, was functionally unrecoverable. It hadn't been hidden, it had simply been lost in bad trades before we ever discovered the theft. That last number was hard for me to accept. Rebecca was straightforward about it. Not every dollar comes back. That's the honest truth of these cases. But the amount you did recover and the accountability you got is a genuinely strong outcome compared to most embezzlement cases I've worked, where the recovery rate is often far lower. Beyond the criminal and civil outcomes, Daniel's CPA license, the one he'd reinstated right before taking sole control of our books, was permanently revoked by the state board once the case became public record. Local business press covered the case, given the scale and the small business betrayal angle, which meant the professional community we'd both been a part of for years now knew exactly what had happened. For someone who had built his entire professional identity on being the finance guy people trust, that exposure was its own form of consequence. Financially, rebuilding Whitfield & Co. took real work. I brought on a fractional CFO immediately, not a full hire, but a part-time financial controller with a mandate specifically to build the internal controls we never had. Dual signatures on anything over $5,000, monthly reconciliation reviews by an outside bookkeeper, and quarterly independent audits, even though we're still a small business. It costs us about $34,000 a year we didn't spend before. I now think of it as the cheapest insurance policy I've ever bought. We kept 4 of our 11 employees through the worst of it by taking out a personal loan against our home, a decision Elena and I made together, and one that terrified both of us, and we've since paid that loan off in full, largely thanks to the recovered funds and the fact that our actual client work, the thing Daniel never touched, had always been genuinely strong. 2 years out, the company is stable. Revenue is back above where it was before the theft. I still, if I'm honest, double-check the bank balance most mornings, a habit Rebecca told me is extremely common among fraud victims, and one I've made peace with rather than fought. I mentioned this earlier, and I want to come back to it directly because I think it's the part of this story people find hardest to sit with. This wasn't a case of a mansion, a hidden fortune, a criminal mastermind living large somewhere untouchable.
The overwhelming majority of the $3.185 million Daniel took wasn't spent on visible luxury. A relatively modest portion, roughly $180,000 across those years, went to genuinely lavish spending. The trips, a watch, home renovations. But the largest share, well over $2 million, based on Rebecca's tracing, simply evaporated into a high-risk cryptocurrency trading pattern that looked, by every behavioral marker Rebecca and later a court-ordered psychological evaluation identified, like a compulsive gambling disorder playing out through crypto markets instead of a casino. He wasn't building a secret second life. He was chasing losses in the middle of the night from hotel rooms while running our company payroll by day, telling himself, I have to believe, that the next trade would fix everything before anyone noticed. It didn't make what he did to us, to our employees, to our families, any less devastating, but it changed how I understood him. Not as a criminal mastermind, as someone who let an addiction consume not just his own life, but mine, and never found the courage to say a single true word about it until there was nothing left to hide. If you take one thing from this story, I want it to be practical, not just emotional. Here are the warning signs, in plain terms, that I wish someone had told me to watch for. 1. Sole financial control is a risk no matter how much you trust someone. Any business partnership, or honestly any marriage, benefits from dual authorization on large transactions and independent, regular financial review.
Trust and internal controls are not opposites. The best partnerships have both. 2. Demand direct, real-time access to your own financial accounts. If a partner, spouse, or manager consistently delays giving you login access to accounts under your own business or household name, treat that delay itself as the answer. 3. Vendors and contractors you don't recognize deserve a 5-minute check, a quick search of a business registration database, a request to see an actual invoice and service agreement takes almost no time and would have caught this years earlier. 4. Vague apologies with no documentation are a stalling tactic, not an explanation. If something is genuinely a mistake, the person responsible can usually show you exactly what happened. If they can only offer feelings and promises, that's information too. 5. Move fast once you suspect something is wrong. Every near miss in this story came down to timing. A forensic accountant and an attorney engaged early can freeze assets before they disappear. Waiting to be sure past a certain point can cost you the recovery entirely. If something like this has happened to you or is happening to you right now, please know it is not a reflection of your intelligence or your judgment. The people who do this are often skilled specifically at being trusted. That's the whole mechanism. I'd genuinely like to hear from you. Have you dealt with financial betrayal? A business partner, a family member, anyone? What happened, and how did you find out? Tell me in the comments. I read every one, and honestly, a lot of the stories we cover on this channel start right there. If this story was worth your time, subscribe, and I'll see you in the next one.